Stocks finished the week very strong on an upswing, a very strong move, showing us some interesting patterns on the market forecast indicator. So I'm going to break down what those patterns are and what that means, and as well as how much more potential we have, not just from an intermediate basis in terms of how do we manage risk reward right now on this current intermediate run, but also from a long-term perspective. Is the next pullback going to be are we going to get kind of another COVID style pullback? Or do we still have a lot more legs left to go on this? So I'm going to talk about that difference between what our intermediate expectations are when you have a mature run like we're on that are showing some mature signs like we've talked about here lately versus your long-term expectations and how we kind of mesh those two together. So I'm going to break that down in today's video. We're going to take a look at some of these strong moves that are about to get very extreme, and we'll talk about why. And which sectors and what's really driving a lot of this. And then we're going to talk about today's trade idea, which is kind of a rare directional move. I haven't been doing a whole lot of directional trades lately, but I saw an opportunity for one here today, so we're going to break that down. And so let's go ahead and get started. Today is Friday, February the 12th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the market forecast indicator with the S&P on the S&P 500 first. You can see we got a cluster, an overbought cluster. A little different than getting them at the beginning of the intermediate run. Again, this time we're in a very mature intermediate run. Doesn't mean we're going to go down on Monday. It just means, or Tuesday, excuse me. It just means that we are pretty darn overbought with all four lines. See, this one didn't have all four lines. They typically don't, obviously, when you're at the beginning of an intermediate run, because usually market sentiment line is pulled back a little bit. But this time we are mature enough in this intermediate run that the market sentiment line's gotten up there. And now we have all four lines up above 80, which is not very common, especially on a Friday, where you finish the week with an overbought cluster. As you can see, we finished the week here with an overbought cluster that almost has the market sentiment line also above 80, and that line. And again, we've been on this run now for a while. So very mature intermediate rallies. You can see these clusters over here that ended this intermediate rally occurred with the market sentiment line above 80. We're pretty darn close right now. These clusters ended this intermediate run. The intermediate market sentiment line was actually already dropping. And then you can see this cluster ended the intermediate run that also had the market sentiment line up above 80 for quite a while. It was a very long, extended run there. So you can kind of see, you tend to get and we've gotten 3 clusters now in the last 6 weeks. So obviously, again, doesn't mean that we have to fall immediately. It just means it just further signifies how mature this run is. And when a mature run, it's hard to break these mature trends on one hand. But on the other hand, it also means too that the downside risk and the upside reward from this point of the cluster are not the same going forward. You can see again, we can have a move down to 37.71, which is 160 points here, about 5%. And that would just be a noisy move. It wouldn't be a pullback at all. It'd actually just be a noisy move. And the further this intermediate line gets up above 37.71, the more, because once you drop below the 30-day moving average, by about 1.5% is kind of the number that I've seen. If you get down below 1.5%, then that's a pretty good sign that that's going to be more than just noise. So the further this, we stay between 0 and 23 without pushing the 0 up higher, and this intermediate line, the 30-day moving average gets up higher, that means you can get that type of 1.5% drop before you break the 23%, which is pretty significant. So as of right now, overbought cluster there, obviously not in the Dow because we've been pretty sideways on the Dow. I didn't get on the NASDAQ either. A little bit of a pullback here, and but still pretty darn bullish on the NASDAQ, and we didn't get on the Russell either because like the Dow, we're not really that bullish. It's been the S&P 500 that has been more bullish than anything else. So very strong move in the large cap index and showing through to some bullishness, and like I said, on the weekly chart as well. I mean, that's a very strong weekly return to be up above, in this case, the 30-week moving average, to get a cluster when you're that far up above the 30-day moving average, with the market sentiment line also up there. And again, kind of a cluster of clusters here, very similar to what we've seen before. This gives you a little bit of a pause for concern. As you can see, the 30-week exponential moving average now is actually crossing up above the 23% retracement of the long-term move of this big long intermediate rally on the weekly chart, which basically aligns with the market sentiment run. So you can see a market sentiment run there, a market sentiment run here. You can kind of get a picture of where the market sentiment runs are, kind of a shorter one there, a big long one here. That, if I were to draw the lines for that one, you can see how this one is shaking out. But if I were to draw the lines for this market sentiment rally, from this low all the way up to that January 18 peak, you can see we never did really break the 20. I mean, we broke the 23 just barely on that run, but not very much. And then, of course, by the time you got the second leg higher and you just kind of stayed up there, then you can see we got all the way down to the 50% retracement of this big long run of that last leg high. Because you would say that we didn't really end this market sentiment rally on a long-term basis, because while we did get dark pink shading, you didn't get a red line to go with it, like you did here and like you did there. You zoom out a little bit more, you did here too, but then you had this big long run, big long extended run for multiple years. That was fueled really by QE3 through 2 of those years. QE3 got you off of this low point here at the end of 2012. That's when we started QE3. And then it tapered off at the beginning of 14, and then QE3 ended right there in October 2014. So you can kind of see visually the power and impact that QE3 had on the markets. And just remember that we have a very similar monetary policy now as we did there, right? We have an indefinite quantitative easing program going on right now, very similar to that one. We haven't started tapering it yet. It's still full on, but we have 0% interest rates now, just like we did there. And we were also there, if you notice, we were also at all-time highs there. So a lot of people talk about, why do we have quantitative easing and 0% interest rates now when the market's at all-time highs? Well, it was at all-time highs there too in 2013, and we had 2 years of it. Even when we were tapering, but we had pretty much 2 years of it there. We weren't at all-time highs when we started it, but we got to all-time highs pretty quickly, and then stayed at all-time highs as we continued to rally through there. From a yield curve perspective, this is what the yield curve looked like during that 2013 timeframe. So here we go. You can see we were down. We weren't inverted, but through 13 and into the beginning, before we started to taper, the yield spread rallied up to its high point. And you can see right now we're getting a yield spread rallying too. And once we kind of hit this peak, that's when they started to taper the quantitative easing program by the beginning of 2014. And so we'll see if we get something similar once we start to taper, if that will start to bring it back down again towards zero, if and when they taper. Which by the time they started to taper there, we were up to 250 basis points. So we actually have a lot of room to go before they even, have to consider that as a possibility right now. One little difference there is that the inflation expectations, as you can see, this is actually the break-even inflation rate. Here, let's go out at 10 years, so we can kind of zoom in a little bit. So here's where we're at now. The break-even inflation rate for 5 years is up to 2.3%. But and we've been rallying really sharply on this program throughout 2013 to 2014. By the time we finished the taper, so right there, the inflation rate was already high when we started the quantitative easing campaign. We actually started it more in this area, but it was already high by the time we started it, up to 2%, and then we actually fell during most of it. So now we haven't started to fall yet, so that's kind of an interesting little development. Obviously, that's going to impact your 10-year note, right, and how that has performed. Here, let me go to the long-term crossover, long-term chart here, and go out that same 20 years. And again, through 13, here's 13. You can see yields rallied until they got to that peak. The yield spread peaked, and then we fell during 14. So we're rallying here Same way again until we hit a peak, which right now we're getting pretty high on how far the 10-year is above the 40-year here. We're up to 10%, and that's in the past, in the last 20 years, that's a relatively high level. We've seen it stronger in some periods. Probably going to get something like that again here, closer to 20% by the time all is said and done. Let's take a look at some of these other charts here really quickly, and you can see from a 3 green arrow standpoint, obviously we have 3 green arrows. That MACD histogram is kind of flattening out. We have below average volume, as you can see down there at the bottom. Easily above the 8-day moving average on the S&P, easily above the 17-day moving average, which are both rising. Very, very strong momentum. If you look at some of these other indicators, we're above 60 on the RSI. We're right around positive 100, easily in the upper half of the CCI. The DMI, not quite giving us that directional move yet, because we can't really get a good drop there. Even though the ADX is dropping, we're not getting a good drop on the negative index, which would make the ADX come back up again. So we're getting there. It looks like it's starting to, and the trend strength is getting back to some trending levels. So we're not quite above 2 yet, or this 2.5 level, excuse me, and the 65 level, which marks a moderate trend strength. Again, we've seen this before where you've had here. Let's go out 2 years. I see something very similar to what happened in this last January, where we had a good long trend, very, very good, strong bullish trend. We pulled back, but not an intermediate pullback, just a pause. And then enough to break the trend, though. And then we started a new bullish, close to moderately strong bullish trend up to this divergent high point. And then that was it. So it looks very similar to what we're seeing here. Not as bullish, but very similar. And then again, we didn't start a bearish pullback, so we didn't get any kind of bearishness here. But we did break the trend, and now we're getting another leg higher to the upside. You usually don't get these big strong legs higher. This one you kind of had back to back right there, because that was one big long intermediate run that was followed by as much of an intermediate pullback that you can have there without actually being one. So those two kind of followed up each other, but that was really one big long run. And then of course here, if we get something like that again here, then we followed up that big huge move with a really shallow exhale, and following up that big this shallow exhale with another big long, very mature intermediate run. So a little bit of a concern from that perspective. It just means at some point in time we can expect more than just a shallow exhale. We've been actually talking about that. In fact, in this week's portfolio management class, I showed you some signs that our next intermediate pullback might actually be more. It might not change the long-term trend, but it might be more than just an intermediate pullback. Some of the signs that I'm seeing from a broader perspective. We spent quite a bit of time in our class this week on that. Let's take a look at let's take a look at the long-term chart. Again, very, very high PPO here. Very bullish candle. Again, very similar to what we saw in 2000. Again, that last little run where we had a couple of transition weeks. We got right back to being a bullish candle. A couple of transition weeks when we're already strongly bullish. Been instead of a retracement, back to a bullish candle. So very similar type move is showing up here that we might be heading into. Again, I don't expect that type of drop, but again, would not be surprised if we had more than just an intermediate pullback, based on again the tools that we use in that portfolio management class. Let's take a look at the intraday chart, and you can see that last little spike. That's what created the cluster. A little spike at the very end of the day, finishing right at the high of the day, finishing right at the high of the week. So we got the cluster on the day and the week. As I showed you, the volume and the trading range are pretty small. Volume was below average, 50 million. The trading range, 3 points. So we're looking at very, very small ranges, below the average, below the volume, well below the average too. 1% is about 4 points right now. So we need to kind of get consistently below that to get back below 1%, which, if you recall, that's kind of the important number to get. If you look at here, let me take off these others here really quick. We'll take off the volume and this ATR here. So for the ATR to get below this 1% level, which is kind of what you get when you're on a bullish trend like this. You can see when you've got a good bullishness, you're back below this 1% mark through 13 and 14 and 15 and into 17, with only pops up above when you have pullbacks, right? Well, we're getting pops up above to 2%. We haven't broken the 1% quite yet to really solidify the long-term trend, which I think eventually is coming. That would coincide with breaking below 20 on the VIX, and we did get a close on the VIX below 20. I wouldn't expect that to really start now dropping, because this is the lowest close that we've had on a weekly basis on the VIX, all the way down here to 75%, just over 75%. The last time we had that low of a close, we got to 75.7% in November 2019, and it still took what, a couple of months before we got that pre-COVID high. But that's how low. I mean, the VIX didn't get any lower. We got down to 11.75 at the end of that week, and that was kind of it. In fact, on a relative basis, it just gradually moved higher from there until we spiked up. And again, you have to go back to like in this area, we finished below 75% in October of 2017, down to about 76% there. And when you get these extreme lows, you tend to follow them up with bullish moves and volatility. It's a very, very extreme low, and very rare to get this low with the VIX up that high, with the VIX up above 20 to be that low. So it just means it's going to be hard for it to keep going lower when it's already extremely low on a relative basis, which is what this chart tells us here. So just keep in mind that, again, before we finally break the 20 and really and finally break that ATR, that 1% of ATR, we're probably going to get some kind of exhale where the volatility does jump up. And one of the things I mentioned in that class is, if and when. Now, first, it's not going to jump from here up to 100%. It doesn't do that, right? It'll jump first up to 90% on any kind of near-term pullbacks, or maybe even up this right now to 85% on any kind of near-term where the blue line drops below 50. But the next time the green line drops below 50, the key to watch will be how far up it goes. And it gets to 105% and stalls there, then we know the green line's dropping below 50, and that's pretty much it. But if it gets up to 115% or higher, then we know we're going to get more than just an intermediate pullback and more of a deeper exhale that might last a little bit longer into the late spring, early summer before we can really get going again on the long-term trend, which I still fully expect to be strongly bullish going forward from here. All right, let's take a look at the different asset classes and how they're doing. You can see commodities are just really doing well. If I go out on this and just go to the last year, we have a 35% return on small caps. These numbers, as I tweeted out last week, are about to skyrocket, because as we drop here in late February into early March, once we get the 1 year starting points down to these negative 30% levels, then that's going to mean even if we just stay flat from here on out for the next month, these numbers are going to skyrocket simply because the starting point is going to get that much lower. You can see commodities have really started to take off since that October, that Halloween low point. So if I were to customize this to last Halloween, when the S&P, not with the Russell started a couple weeks earlier, or a month earlier, but this is when the S&P started its intermediate rally. From that point, you can see 20% run. So since Halloween, the S&P is up 20 whopping percent. That's a really strong number going into and through the election and through all the issues surrounding the election, and now coming out on the other side of all of that. The S&P has shrugged, and COVID and everything. One of the worst periods of COVID that we've had, from spreading it. It's been the worst period that we've had with the COVID. So the S&P is up 20% like nothing, right? It's up there. Real estate's up 17%. Commodities are up nearly 30%. They're really moving strongly to the upside. Emerging markets also up there too. Small caps are up 50%. 50% since November, December, January, and middle of February. So 3.5 months at 50% return. with long-term bonds really only down about 6%, and gold only down about 3%, and the dollar down, a couple percent. So, again, as strongly bullish as a lot of this is, and you can see from a linear regression the maturity of this move, right? It's a very, very mature move here. Looking at it on a long-term basis, we are 2 standard deviations on small caps. We are way more than 2 standard deviations on large caps. Long-term bonds are still falling, so I'm not too worried about, like over here in 18, we were way down here on this chart. So that was a concern, that a little bit of a concern in terms of, are we too bullish in risk appetite? So that's why I'm saying, like, even if we get a little bit of an exhale here, this doesn't tell us that we're like way oversold in the safe havens, right? They're still very strongly bullish. And when you look at the dollar versus the euro, you can see the dollar has a lot more room to fall. It's not nearly oversold as well either, not at all, not in the least bit. So it's got a lot of room to go. And then, as I mentioned, gold as another safe haven asset class isn't as oversold as it was in late 2018 either. In late 2018, all these safe haven assets were all very oversold. Hence the bear market that we've had since then. And that culminated with the COVID volatility and everything, and right after that. Since then, we're starting to pull back, but we haven't pulled back enough to be too much of a concern. And commodities haven't rallied enough to be too much of a concern. As you can see, they had their big super cycle peak there in 2008, and then they've been in the underperformance. Well, they're just starting to go up. They have a lot of room to go. Remember, they're the last thing to peak before equities really peak on a long secular type cycle. So, again, don't confuse intermediate expectations with long-term expectations. Even if we get an exhale and that turns out to be a little bit deeper here, in the next, like in the next so many months, like late into spring, maybe early summer. Even if within that period we have a month or two of where we go down and we just kind of hang around down, that doesn't mean from a long-term perspective we still have a lot of room to run, despite the fact that valuations are as high as they are, and despite the fact that we're getting these insanely high 1-year returns. That just means our intermediate returns, intermediate expectations might not be as much. There's not as much upside in the intermediate term as there is downside because of how strong those numbers are. But again, because of how strong those numbers are, it shows how much still we have in the long term to still be pretty strongly bullish from a risk appetite standpoint. And like I said, commodities, which usually peak last, have still a long ways to go before they get away from the mean, which is a downward sloping mean that you have right now in commodities. Taking a look at the different global markets and how they're performing again, you can see here, let me get up the major ETFs, all dark green shading, green line all across the board. Really, Brazil is the only one that's lagging behind. Italy has got a cluster like US, but those are the only two. Let's take a look at how the sectors are performing. And again, you can see, again, going off that same October Halloween low point here from last year. Remember, where small cap stocks are up 50% practically. Energy is up 55%, and financials are up 32%. And there's your technology sectors, 25% or right around the 20s, and your safe havens lagging behind. And they've really done well coming off of this 129 low. So from 130 on here, just this last couple of weeks, you can see the type of returns that they have, these different sectors have had. Energy, the S&P is up 6% off of that low. Energy is up 13.5%. Financials doing very well. Industrials doing very well. Communication services, technology also, and then your safe haven areas lagging behind. So, these are the sectors that are doing well. They continue to do well, and you expect that they will until we get more of an exhale, which will bring this ratio here back to a normal run. You can see, like, if I update this chart, it still hasn't really started to rally yet. And so as long as we stay bullish, for however much longer we'll stay bullish, right? Here's the October 31st low, and you can see small caps right there. Small caps were already, a month earlier, had already started their outperformance before the S&P started. So as long as this line continues downward, then we can expect markets to be bullish. But we are getting some divergences on these different oscillators, CCI, MACD, RSI. We are starting to get some oscillators. They are turning higher. And again, that's until when this turns up and we change around to more of a bullish scenario, that's actually going to be bearish for the broader market first, right? Because energy, financials, industrials, the sectors that have really done the best, they're going to be the ones that lag the most before things. In fact, if I were to go out on this chart here, this one, here, if I were to go out on here, all the way back out to that 924 low, when small cap started their outperformance run, so we'll go out to a daily chart. So again, S&P is up 21% off that 924 low point. Energy kind of lagged behind, was actually down 8% initially, and utilities was the big winner early. So energies, despite that weakness early, energy is up almost 50%. Financials up 35%. There's your technology, communication services up more than 25%, and everything else kind of matching the market's return, except for all the safe haven sectors, which are all positive, between 5 and 15% higher during that same period, but obviously well below what you're getting in these more cyclical areas. So for today's trade idea, I saw something that had, again, I'm kind of being pretty selective in my directional opportunities, but one stock that I saw that looks like it's got some potential for a directional move is Delta Airlines. Delta Airlines, you can see, has had obviously been hit pretty hard, and unlike some other stocks, has not exceeded its pre-COVID highs. In fact, had been relatively bearish going into COVID anyway, and then really dropped sharply. We've gone up through the retracement zone. Now we're sitting at the top of the retracement zone, coming off of an oversold cluster, starting a new intermediate rally to the upside. You can see what the long-term crossover chart looks like here. We had a golden cross. We've retested a 200-day moving average, and now we're bouncing back up with a pretty strong bullish candle this week. You look at its 3 green arrow chart. Obviously, you've got, we just barely got a good surge in momentum to start what may be a new intermediate run. Same thing on some of these other oscillators here, like the RSI and the CCI, making way up above 60 and above 100 there. The DMI also showing a directional move here with being above 30 and well below 20, with a rising ADX. The Bollinger Bands, this is where the directional move opportunity is. Very, very little volume there. In fact, if you go out just 2 years, you can see there's a huge gap in volume between where we're at now and getting back up to those COVID highs. So if we can break this 62% level, it's very easy move up to the upside with a rising bandwidth here after kind of this tightening that we've had for so long. Early this year and then late last year, we've had this big tightening, but now it appears that we've broken out above that tightening. We're in the upper quartile of the weekly bandwidth and really making a run to the upside. Here is linear regression. You can see, a lot of room. Again, if I were to go out, say, 5 years on this, so you can see the full linear regression channel. We've been below it for so long, and it looks like we might be on the cusp of breaking up above into the upper half of the bandwidth. And so what we did, because of the directional opportunity, we thought, okay, well, we'll just give ourselves some time within that 150-day mark. We'll buy this at the money option, put a stop order at 50%. So that's what we did. We bought it there, I believe, at, what did we end up getting it at? 440. We bought it at 440. We have a stop order at 220, I believe. Yeah, we got a stop order at 220. 3 contracts, which means worst case scenario here. Worst case scenario, we lose half of that, so about $600, $660 is our worst case scenario. But if we get up to that pre-COVID high by June, which, right now you can see the Bollinger Band or the volume profile says that that the volatility suggests we can get all the way up to 57. So if we get up to that point, then for that $600 of risk, we're looking at about $2,500 of reward. So pretty good opportunity for some upside and more reward if it gets there faster, right? If we blow through, which again, this suggests kind of a normal move to the upside, but if there's very little volume to the upside here, then we can get here even that much quicker because of the lack of resistance in that area. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to your Market Outlook forums on our website. Open up any new thread. It's a community message board, so open up any new threads, reply to anybody else's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, like us on YouTube as well as on Twitter and Facebook, and then comment on the videos. Always have a great rest of your holiday weekend here, everybody, and we'll see you all next week.